G'day guys, Steve here from Deleen Property Group and Picker Financial Solutions. Today we're having a look at a case study. So this is a pretty simple breakdown of one of our clients who came through the door a couple of months ago, read Eddie's book on a flight and looked to book in a session with myself actually. They came through the website initially, booking in a consult. People that have got finance sorted, we've got property strategists that just focus on the strategy side of things. This client in particular didn't have finance sorted, so wasn't working with a broker, didn't have a pre-approval, so they got put through to myself. We reviewed their scenario and kind of went from there. So client's name has been changed in the kind of case study that we're doing here. So for the rest of the video, we'll refer to this person as Chris. Like I mentioned, Chris reached out to DPG after reading Eddie's book. He was keen to use a buyer's agent for his first property and potentially more moving forward depending on how the experience went, which is pretty common for first-time investors or even just first-time people coming through and using the service. What happened initially was we jumped on a call, got to know Chris a little bit better, understand his scenario. He basically had, I think, like 100K in the bank from savings and was keen to have a look at his borrowing capacity and what his options were. So we went through all that sort of stuff on the phone, gave him an idea of what we do here, how it works at Deleen Property Group, jumped into his finances, had a bit of a kind of a rough look at things. And as we got towards the end of the call, the kind of next steps for him in that scenario were to get his docs into us, get a broker form in, sign a credit guide, and we were able to jump in and have a look at his numbers. Basically had a borrowing capacity of 300 to 325,000, which was relatively conservative. So when we're looking at a borrowing capacity, we kind of need to be conservative on the broker side because we don't know the property yet, you know, the postcode, the internal floor space, different metrics that are going to dictate which lender we end up going with once we've got the contract. We need to be somewhat conservative with the rental figure because we don't know where we're going and we don't know exactly what that rental figure is going to be. But 300 to 325 was comfortable for Chris. So once we'd finished up with his borrowing capacity, we went back to him. He looked to sign on with Eddie and get started from there. So from there, he went away, worked with Eddie to find the property that he was looking for. So he picked up a contract with Eddie for 295,000 as the purchase price, renting for 350 on a fixed lease. It had a couple of months left to run on that fixed lease, and that kind of going back to using that conservative rental income figure from a servicing perspective for the estimated borrowing capacity, because we don't know the rental income of that property and the lenders are going to use the existing lease in place at purchase. Sometimes we can look to use a rental appraisal if it's not tenanted, or if it is tenanted but it's periodic, but generally if it's fixed, they'll use whatever lease is in place for servicing. And quite often what you'll find, especially in fast moving markets like here in Perth at the moment, you'll find that a lot of leases that were written 12 months ago are very different to what you'd get in today's market. So we kind of need to be conservative. He's got the rental return there of 350 a week. He's got a rental appraisal there of 450 to 500. And for a two-beddy place like he picked up for, you know, here in Perth at the moment, you could potentially even get a little bit more than that. But that was sort of the rough scenario. Came through the door, did the borrowing capacity, we did his finances, secured a contract with Eddie, and that was sort of the opening steps. There's a lot more to break down on that side of things, but that's kind of the rough overview, so we can jump into the finances. The first thing that we're looking for from a broker's side of things, whether it be from the estimated borrowing capacity point where we're first checking his finances to when we're actually looking at his loan preferences once he's found a contract, it's basically income versus expenses. So you might have all your assets in the background as well, from cash to super to, you know, cars, houses, whatever, but they don't really have an impact on your servicing. They might have a little bit of an impact on your risk profiling, like they expect you to have assets somewhat in line with your living status, you know. So if you're a couple, you know, in your 30s, whatever, they might expect you to have a certain amount of assets behind you to kind of lower your risk if you're looking to take lending out with that lender. So in Chris's scenario, he's working permanent full-time as a trainee software developer. So on 55,000 a year, doesn't make anything in allowances or overtime. So that 55K base is everything, single with no dependents, living at home, rent-free. So you'll see notional rent there in the brackets. So notional rent is the rent that the lenders apply to your scenario, regardless of the fact that you're not paying rent. So if you're paying no rent, you live with family, you live with friends, whatever the scenario might be, they'll still use notional rent regardless, because they need to take into account, you know, is this person going to be, you know, potentially moving out, or whatever the scenario is. So lenders use anywhere from say 450 to 650 a month. I don't know where you'd rent for 450 to 650 a month at the moment, but that's the metrics that they use when it comes to the notional rent there. He's got a HEX debt of $17,600, so that's a It's another one on the liabilities column, afterpay limit of $1,500. So afterpay, zip pay, credit cards, any of these unsecured debts, depending on what the limit of those credit facilities are, they can have a pretty big impact on your servicing. So a general rule of thumb is, depending on the lender, you'd want to take the limit of your combined unsecured debt, so credit cards, afterpay, zip pay. Let's say you've got a $2,000 credit card, $1,500 afterpay, and a $3,000 zip pay, which is 6.5, if my memory doesn't escape me, in unsecured debt. So you could probably times that by anywhere from 5 to 10, and that's how much your borrowing capacity is going to be reduced by. It doesn't matter if you're paying that debt off every month. It doesn't matter if you don't use it. The lenders don't care. It's the limit that is the issue when it comes to servicing. Generally, we don't tell people to get rid of them. That's not our job. We don't give advice. It's more that it might have an impact on your servicing, and normally we can make it a finance condition. So you don't have to close them straight away, but once you're conditionally approved, so we've got the loan in the system, we can look to make it a finance condition. So finance approved, subject to closing those cards. That way you know that your file's sort of safe and your application's ready to go. You've just got to do these 3 or 4 tasks, and closing up some of your existing liabilities might be on that list there, depending on your scenario. Below HEM, general expenses. So this is your household expenditure measure. This is what the bank uses internally to assess your scenario. So depending on your living status, your income, dependents, whatever the scenario might be, each lender has their own algorithms as to how much they expect your general expenses to be, from food to medical to recreation to any owner-occupier housing expenses, childcare, whatever it is that makes up your outgoing costs will fall under your general HEM expenses. The lender will use whatever the higher is of what their estimate is or what you declare. And most people generally will declare a lot less than what they spend. When we jump into their statements, it's usually a little bit more, but we'll kind of help clean that up, review that again with the client, and bring it into line with where it's actually meant to be. The HEM estimates from the bank are usually a lot more. It's not rare, but it happens less often where your actual expenses are more than what the bank estimates. But regardless of which way it goes, they'll take the higher of the estimate or what you declare. So that's your general expenses. There's also what they call additional expenses back on top, and this is kind of a blanket rule for most lenders, but not all of them. Additional expenses can be anything from strata for your owner occupier, private health, life insurance, child maintenance support, different costs like that they put back on top of your general expenses. So if they've estimated $2,500 per month in general living expenses, regardless of how much it actually is, that's where that will cap, and then any of your additional expenses will be added onto that. So in this scenario, nothing applied to Chris outside of his private health. So he had $120 per month with the I think it was with Bupa. That's kind of a rough breakdown of his scenario. Relatively low asset position, just with cash and a small amount of super. Didn't own his car, didn't own a caravan, didn't own whatever. But he's only young, living at home, rent free. Once he'd actually exchanged on a contract, so that's when we come back to do finance. So depending on your scenario, if you've got a very tight financial scenario, we might look at a pre-approval. Yet generally you'll find with a pre-approval for an investment property, it can be a little bit more of a hindrance and more of a handbrake than you would expect. So you would think, pre-approval, get your finance sorted, go through and find a contract and go from there. The problem that you'll find with a pre-approval is that once you've got that pre-approval, you're locked in with that lender. So you've got a contract ready to go, a pre-approval ready to go, and then you're out shopping for a contract. The problem is, once you've found that property, different lenders have different metrics as to what they accept as security, from minimum internal floor space to how far from high voltage power lines or a power station or an airbase or whatever it might be that could pull you up from a finance perspective. That might happen at that point. So you don't want to end up going shopping for a contract for the lender. You want to find the contract and then find the lender that's going to back you in that scenario. So unless you've got a really tight financial scenario, we find going through with the borrowing capacity is generally the way to go. So what Chris requested here in regards to his loan preferences was something that we see quite often. He wanted to see both a 10 and a 20% deposit option. No right or wrong answers here. Generally, if you want to go in with a smaller deposit, most people's reasoning is that they want to hang on to more cash for another investment in the near future. Normally, people wanting to go in with a bigger deposit are looking to avoid paying lender's mortgage insurance, get some cheaper rates, lower their repayments on the back end of it as well. Personal preference. There's no right or wrong answer there, but we can give you those different options and we can look at the different pros and cons based on your scenario. So there's that we can certainly jump into based on the specific scenario, but in this situation, that was what Chris wanted to do. Repayment type. So this is where we look at principal and interest versus interest only. I would say 90% of our clients that come through from the investment side of things, so not when we're looking at maybe refinancing their owner occupier or whatever the scenario is. Generally speaking, with the investment properties, we'll see clients go for interest only repayment. No right or wrong answer on that side of things. It's completely up to you. It's a personal preference, again, based on your requirements and objectives. A lot of people will look at Eddie and kind of think, what did he do to build his portfolio? He generally finds that being cash flow positive, or at least focusing on cash flow as a core metric of what you're trying to do, is a very important measure. And for first-time investors, this can be a bit of a hard one to pick up on, because for us that, I'm in my early 30s, like I came from, my parents are obviously in the boomer generation, which is, you buy a house, you get married, you have kids, you pay it off. Like that's the sort of standard metric that we grow up with. And it feels very counterintuitive not to pay your debt off. And if that's what you want to do, totally fine. There's no issues with that. But interest only can be a really good tool to not have to pay the debt down. You've got slightly more expensive rates in most circumstances to go interest only, but your cash flow is normally better. And when you're looking at one property, it doesn't make a huge difference, but when you're looking at 5 properties, that's when it really starts to add up. So 300 might become 1,500, and it's a fair chunk of change that seems to come out at the end of every month. Again, no right or wrong answer there. Fixed versus variable, if you're looking at owner-occupier loans where you're looking to get one loan and fix up your repayments for 3 years, like fixed is normally the way to go. Variable for most investors is, generally speaking, a more favourable option, because this type of lending is very much about refinancing and releasing equity. Being variable offers you that flexibility. You don't have any break costs, and you can move your debt around much more comfortably than you would if you were fixed. But again, no right or wrong answers there, and we're happy to break that down depending on your scenario. We looked at, like I said, 2 different loan options there for Chris, a 10 and a 20% deposit option, both interest only and both variable. So the 10% deposit option that we looked at for Chris was with AFG Home Loans Retro. So it was a good combination of cheaper LMI, or slightly more expensive LMI, but the cheaper interest rate worked out better over a period of time. I can't remember exactly the metrics as to why it was a little bit better, but basically at 6.9% of an interest rate, and you can see the different breakdown in the numbers there. It made more sense for him over the short and the long term, even though he probably will look to refinance this loan at some point moving forward. You've got monthly repayments of $1,514 per month, the interest only term of 5 years, and a total loan term of 30 years. So what's good with the interest only term of 5 years is you can bring that forward whenever you want. So you set it at 5 years, but after 18 months, if you wanted to bring it forward and knock on and start paying down that principal and shift it to P&I repayments, you can. You've also got the lender's mortgage insurance there, because it's less than a 20% deposit. So you'll find that lender's mortgage insurance is on a sliding scale. So the smaller the deposit, the bigger the LMI, and in reverse, the bigger the deposit, the smaller the LMI. So LMI worked out to be $3,828.95. You can see the base loan and the loan including the LMI in there as well. And that was kind of the different bits and pieces that made up the 10% deposit option there. So for the 10% deposit and the fees, the ones that are associated with the purchase price of $295 and the application fees and whatnot that the lender charge on top of that as well, we're looking at a total funds to complete of $47,500. So for an application and settlement fee, you're looking at $425.70. So that's what the AFG Retro charge. Not all lenders charge an application fee. Some are more than that, some are less. And that's what we've got in this scenario. The LMI, as we discussed. Government rego of $203. Conveyancing fee of $2K. So that's an estimate from us. Could be as high as, I've seen it over $3,000 before. I've seen it less than $2 as well. That'll obviously be up to yourself and your solicitor. So we use $2K. It's a bit of a midpoint. Stamp duty of $8,645. Transfer fee of $253. And you'll see here a 10.74% deposit of $31,683 now. So when we mentioned that sliding scale before of a smaller deposit brings on bigger LMI and the opposite, what you'll find is it doesn't actually happen in full percentage brackets of 11, 12, 9, 8, whatever. It happens in it happens in small brackets along the way. So 10.74 to 10.21 might be a bracket. Depends on the insurer and it depends on the lender, depending on which insurer they use. And so your broker will know this. So at 20%, because you don't need to worry about lender's mortgage insurance, you'll find that your loan is at a perfect 80%. You'll find that usually there's a break somewhere between 10 and 11% that has quite a dramatic jump. And so in this scenario, if we were to put in a smaller deposit slightly and need more lender's mortgage insurance, what you'd find is that it jumps up quite dramatically. I can't remember the exact figures. It might be like say $1,000 or $1,200, and when you're only looking at $3,800, it's a pretty steep jump. So your broker will know that and will be looking for the break point that makes the most amount of sense based on your deposit size. So we've got that there. Total funds to complete of $47,500. That's rounded up slightly by $300 or $400, but they're the fees, and that's what we're looking at. And the 20% deposit was next. So that was the one that we looked at with Chris. It was a loan with Newcastle Permanent. The product was a Premium Plus package. They've all got kind of different names for their different products, but this is one of the ones here at Newcastle Permanent. Baseline of 236, so you'll find that that's bang on 80%, unlike we saw with the 10% deposit. So the baseline amount of 236, no LMI, interest rate of 6.33, monthly repayments of 1,244. So you can see they've come down quite a lot from the 10% deposit, say $270. So a fair bit of a difference, but it's a fair bit more capital that we're putting down, as we'll see in a moment. Interest only term of 5 years. Again, we can always look to bring that forward if we need to throughout the process. If you start on P&I repayments and want to move to interest only, you'll find that you actually have to do a new application, which is a lot more difficult than obviously going interest only to P&I, because that's just a phone call. You're saying instead of paying the debt back over 25 years once the interest only term ends, you're saying, can I bring it forward to 28 years and 6 months, or whatever it might be. Where if you're going to go from P&I to interest only, you're actually asking to shorten the amount of time that you pay the debt back, meaning that in theory, during that period, you're going to be making higher repayments. So they need to assess your scenario again to see if you can make repayments at a higher amount, and they'll need to assess that as a full new application. So that won't be something you can do, as simple as a phone call like you can with the interest only to P&I. The fee information for the 20% deposit. So I think the only difference here was obviously the deposit size, but the no application and settlement fee for Newcastle Permanent. So that's just how things roll on their side of things. Total funds to complete, 70,500. So that's a bigger chunk of change than what we were looking at with the 47,500. But depending on what is more important to you, and when we went through the different options for Chris himself, he was keen to buy again within the next few months. So hanging on to the capital was more important to him in this scenario. It's all personal preference and personal circumstances, but we'll discuss those different things as you come through the door and make sure that we line the loans up, best with what lines up for your requirements and objectives. So once he had locked in that he wanted to go ahead with the 10% deposit option, for us as brokers, we next send through a credit guide and a credit proposal. So we'll already have sent that through to you when we're in that draft stage, when we're looking at different options. But at this point, we'll send it through via DocuSign. That'll get signed and then come back to us. Then we're ready to move you down the line and start getting you ready for processing. So processing is where we issue the lender's official documentation on their behalf and get all that over to you via re-sign. You'll be able to sign those electronically, which is obviously very convenient, and look to go from there. If you've obviously got any questions, that's a point where you can reach out to your broker and get a better understanding of what you're looking at, because it can be quite daunting the first time, but that's certainly what we're here for. So once they come back signed, the lender application forms, we may have already requested some additional documents. So because you'll get an estimated borrowing capacity initially, and then you might go away for a few weeks and come back with your contract, we might just need some new pay slips, or your driver's license is expired, or whatever it might be. We'll let you know at that point what's missing, then come back to you requesting that information and get that one in the system. That's our next step, is to lodge that application, the application forms along with your docs, and basically go from there. So different lenders have different turnaround times. You'll find your more major banks have quicker turnaround times. Your second and third tier lenders can vary. It really just depends on their queue times at the time, but we'll let you know that so you understand what kind of time frames that you're looking at. The next step is pre-assessment. So pre-assessment is where someone will review your file They're not actually checking your credit or your servicing at this point. They're just making sure that all your documents are there. They'll come back to us if anything's missing, if we've missed something or there's something in addition to your scenario that they're requesting. Normally PAYG people are pretty straightforward. You're self-employed and contractors and stuff like that might have a few more documents that we do require, usually SMSF lending and trusts as well. There's a fair bit of docs that we do need there, but for most applications it's all pretty straightforward. And then you'll pass pre-assessment, so that's when it goes through to credit. So you might have another couple of days that you're waiting for it to go from pre-assessment through to credit, but once it goes through to credit, that's when we're in the assessment stage. So they're looking at your file, they're checking against what we've submitted from the application to the pay slips to the documents to whatever, and they're making sure that it all lines up with your scenario. The next step is normally conditional approval. So sometimes you'll go through straight away to formal approval, more common with refinances than purchases, because normally with a purchase, when we lodge the application, around that time is when we're ordering the valuation for the property as well. So even if everything goes through first time from a servicing perspective and from a credit assessment perspective, normally we're still waiting on that valuation. So that can take however long it is. There may be other conditions on there like closing an afterpay or an extra pay slip or, like I said, expired ID or whatever it might be. That's the point where we'll be notified, and we'll come back to you requesting it if we don't have it already, or if we do, we'll supply that through to the lender. So let's say that everything else was all clear. The only thing we're waiting on is the valuation, and then that comes back in. What you'll find with purchasing valuations is that they come in at the very highest at purchase price. So they don't come in any higher than purchase price for a purchase, because the lender's just looking to make sure that you with their money aren't paying too much for that property. That's the only concern from a valuation perspective at that point. It seems kind of ridiculous. I've always wondered why they don't just assess at raw market value, but that is what they do, and go from there. So you'll get that val back, or we'll get that val back, and we'll submit that through to the lender. And if it's coming at purchase price, bang on. And normally a couple of days after that, that's when we'll get formal approval. So happy days at that point. So once you're formally approved, you've got a finance clause in your contract. You can waive that one at that point if you choose to do so. You'll do that through your solicitor or conveyancer, and you've probably already got your pest and building done at that point. You may have already waived that clause at the time you're waiving your finance, but if you can do it all together at the same time, you've got that option as well. And then you're in between the period of formal approval and settlement. So this is where your conveyancer or your solicitor, that's where they kind of come into play. They're looking at your certificate of title, they're looking at your building insurance, they're getting you ready for settlement from a funds perspective and making sure everything's in order. We're tracking your progress as well and giving you updates based on what we're aware of. Settlement is a fair few different things all happening at once, from the seller to the selling agent to the solicitor to us to the lender. Everyone's trying to talk to each other to make sure everything happens at the same time. It all goes through pretty smoothly sometimes. You might find that it gets delayed here and there if you're waiting on a document or someone's not ready for whatever reason, but that's normally the point in which all that will happen. Your settlement goes through, happy days, your loan's drawn down, you've got your account set up. There's a few other things that we could go into there, but it was more the general overview of someone's loan and kind of the different steps along the way. There's a bunch of other conversations that we could go into there to have a look at setting up your accounts to whatever it might be, but kind of just wanted to give an overview of a pretty standard scenario. Living at home rent free, like, you're not going to get a more basic and straightforward scenario than this. We'll definitely look at some more complex scenarios like SMSF lending, or people with multiple properties, or self-employed, or whatever the scenario is that kind of takes it into a field where there's a bit more work to be done and a lot more to be assessed on our side of things and the lender as well. But for now, we'll just sort of leave it at the pretty basic one there. My name's Steve. I'm a mortgage broker here at Picker Financial Solutions and Deleen Property Group. I'm a property strategist here for Deleen Property Group and a mortgage broker here for Picker Financial Solutions. So we merged the two together to give you an understanding of your scenario. I've got my details there below if you want to reach out. You can obviously book in for a session through Deleen Property Group as well. If you've already got finance sorted, you'll go through to one of the property strategists that isn't a mortgage broker, just to talk about the strategy of investing in property if you've got a broker or a pre-approval or whatever. If you don't have finance sorted, that's when you'll come through to myself or Jerome or Justin, the team here at Picker Financial Solutions, to run through your scenario. If you do have a broker or a pre-approval and you just do want to find out a bit more about your finances, feel free to get in contact and just say, we do want to speak to your finance team. More than happy to review your situation. We don't like pinch and work from anyone. So if you do have a broker and you just want some extra info, that's when we'll hand it across and you'll be able to go back to them and get your deal done. Thank you so much for watching. Definitely looking to knock together a few more of these case studies. So if it's something you're interested in, a little bit of a more, I guess, long format type of content where we break down a bit more information and kind of break down all the details and the bits and pieces that go into certain applications and lending scenarios and bits and pieces like that. This is a pretty quick one and I've rambled on for a long time, so they might go for a little bit longer, the more complex ones, but if you've found it valuable, hopefully there's some more gold in the next ones as well. So thank you very much for your time. Hope to speak to you soon and we'll go from there. Cheers.